Three of the four major indexes closed lower today, the fourth one closed higher, and the group that led the entire market was uranium, energy, and electric utilities.
Which is the rotation a lot of people have been waiting for. Power up, software down. That is the shape of the session.
And then there is the part that keeps this from being a celebration. The whole session traded on roughly 70% of normal volume. Almost nobody was at their desk.
So something rotated today. Nothing got confirmed. Those are two different statements, and we are going to keep them separate for the next 20 minutes.
We are also going to correct ourselves on air because we went back and checked how we have been measuring volume this past week, and we found we had been overstating the case. We also want to spend real time on a question underneath the day, which is whether the power sector has finished building its bottom. Our answer is split, and the split is the interesting part.
Everything we say about that is our reading. We will show you what it rests on, and you are free to weigh it differently. Quick note, this is education and entertainment, not investment advice. Companies are examples. Never buy or sell calls. Do your own research.
The S&P 500 closed at 7,728.20, down 0.32%. The Dow closed at 53,791.85, down 0.34. The Nasdaq Composite closed at 26,445.45, down 0.6%.
So a quiet down day at the index level. Nothing dramatic. The Nasdaq was the worst of the three, which tells you where the selling was.
And then the Russell 2000 closed at 3,027.12, up 0.32%. Higher. On a day when the three large-cap indexes all fell.
That is worth pausing on, because it is the opposite of what a risk-off day looks like. When people are genuinely reducing risk, small caps go down harder than large caps, not up, while large caps go down.
The volatility index closed at 15.8, down 0.18%. That is a low number, and it went lower. And the 10-year Treasury yield finished at 4.684%, down about a basis and a half. Barely moved.
So, large caps down a little, small caps up a little, volatility low and falling, bonds flat. That is not a market taking risk off. That is a market moving risk sideways from one place to another. Which brings us to where it moved it.
Here is the sector board, top to bottom. Uranium miners, up 1.78%. Energy, up 1.25%. Nuclear, up 1.23%. Utilities, up 1.16%. Industrials, up 0.6%.
5 sectors green, and 4 of the 5 are some version of the same trade. Uranium, nuclear, energy, utilities. That is electricity and the fuel that makes it.
And the other end, software down 1.04%. Real estate down 0.72. Communication services down 0.5%. Consumer discretionary down 0.36. Staples down 0.31.
So the losing side is led by software, and the winning side is led by the physical inputs to computing. Those are the two ends of the same industry.
That is the framing we would use, and it is the one the day actually supports. The money did not leave the artificial intelligence trade today. It moved to the other end of it.
Although we are going to complicate that in a couple of minutes, because the phrase, the AI trade fell, turns out not to survive contact with the data.
The sector moves understate what happened in the individual names. Talen Energy closed up 4.28%. Constellation Energy up 2.93%.
Those are the two independent power producers with the largest signed contracts to sell electricity directly to data center operators. And they were the two best performers in the group.
Vistra up 1.43%. NRG up 74 hundredths. American Electric Power up 0.6. Bloom Energy up 28 hundredths.
So the merchant generators led, the regulated utility followed, and the fuel cell company brought up the rear. That is a clean ordering, and it is the ordering you would expect if the market were pricing contracted demand rather than a general enthusiasm for anything with a power plant.
And then one name did not participate at all. Centrus Energy closed down 0.08%, flat to slightly lower, on a day when uranium as a sector was the single best performer on the board.
We are pointing that out rather than smoothing it over because Centrus had arguably the best quarter of anyone in this group, and we will get to it. The stock did not care today.
So, here is where the easy version of today's story breaks. If money had genuinely rotated out of artificial intelligence and into electricity, you would expect the semiconductor complex to be down.
Semiconductors were up. The semiconductor ETF closed higher by 0.62%. Green on a day the Nasdaq lost 0.6, though we will note it did that on light volume, so we would not lean on it too hard.
Meta closed up 0.71%, also green. Nvidia closed down 0.02%, which is as close to unchanged as a stock gets.
So what actually fell? Alphabet, down about 3.6%. Amazon, down 2.09%. Broadcom, down 1.50%. Microsoft, down 0.44%. And software as a group, down 1.04%.
That is a much narrower list than artificial intelligence sold off. That is software, plus 2 specific megacaps that each have their own story, plus 1 semiconductor name.
And it matters, because the 2 versions imply completely different things. AI sold off and power caught the money would be a warning about the whole trade. What we actually got was money moving within the trade, from the compute and software in toward the electricity end, while the chips themselves held.
Our read is the second one. The build-out is not being doubted today. What is being repriced is which layer of it captures the value.
And we would rather say the narrow, accurate thing than the wide, dramatic thing. The wide version would have been a better headline. It just is not what the tape says.
Now the part we care about most, and the part most likely to get lost if you only read the sector table.
Every single one of those leaders traded below its own average volume today. Not the market's average. Its own, measured over the last 2 months.
Utilities, 97% of normal. Talen, 89%. Uranium miners, 84%. Constellation, 78%. Nuclear, 73%. Energy, 71%.
It gets thinner further down. Vistra, 65% of normal. NRG, 64%. American Electric Power, 52%, barely half. Bloom, 51%.
And Centrus, 39%. That name traded on a bit more than a third of its normal volume.
And the reading that follows from that is the one we have been giving since the 4th of August. The power complex went up because very few people were willing to sell it, not because a lot of people arrived to buy it. Those look identical on a price chart, and they are not the same event.
Except we went back and checked that reasoning today, and it turns out it needs a correction. So we're going to correct it on camera rather than quietly.
Here is the problem with measuring today against the 2-month average. Every single company we just listed reported earnings inside those 2 months.
And an earnings day is not a normal day for volume. In this group, the busiest day in that window ran between roughly 2 and 6 times the typical day. NRG's peak was almost 6 times. Centrus and Bloom more than 4.
So the average is being dragged upward by a handful of enormous days, which means every ordinary session gets measured against a benchmark that includes its own earnings spike, and every ordinary session looks thin as a result.
The cleaner way to ask the question is to use the median instead. The typical day, ignoring the spikes. And the picture changes.
Measured against a typical day, utilities traded at 104% of normal. Talen, 102%. Both slightly above an ordinary session, not below it.
Constellation moves up to 85%, NRG to 81%, uranium miners 93%, and the broad market sits at about 72%.
So the sentence, "Nobody showed up for power today," is not right, and we should not have been comfortable with it. On a typical day basis, participation in the power complex was normal to slightly above, on a session where the market as a whole ran at about 70%.
We also widened the sample, because our first cut only looked at the sectors we were already interested in, and that is a way to prove yourself right by accident.
With every major sector included, the ranking holds. Real estate, utilities, Talen, and materials at the top. Technology at 56% of a typical day, financials at 55%, consumer discretionary at 47%. The buying was ordinary, and the selling was genuinely light.
So what survives, and what does not? What does not survive is the rotation happened on no volume. That was too strong.
What does survive is that there was no surge. Nothing here traded at 150 or 200% of normal, which is what an actual trend change tends to look like. And there was no capitulation on the other side either.
So we still would not call this a breakout. That word has not been earned, but the more accurate word is unconfirmed, not ignored, and we had been drifting toward ignored.
One last detail. The single heaviest participation on the board was real estate, at 112% of a typical day, and it was the second worst performer.
So the one place people did show up with real conviction, they showed up to sell. Which brings us to the question we actually want to spend time on. Has the power sector finished building its bottom?
Because this group had a rough stretch. And the reason the question is interesting is that we think the answer has two halves that point in opposite directions.
The business case looks like it bottomed. The ownership case does not look like it has.
So we will take those one at a time, starting with the businesses, because that is the half where the evidence is strongest and most checkable.
Constellation Energy reported adjusted earnings of $2.55 per share against expectations in the range of $2.29 to $2.37. It raised full-year guidance from a range of $11 to $12 up to $11.50 to $12.50.
And it signed 920 megawatts of new long-term contracts, averaging 18 and a half years. That includes 176 megawatts with Walmart. And to be precise, that one is structured as two back-to-back 15-year agreements beginning in 2029 and 2030. Not a single 15-year deal.
Centrus Energy reported adjusted earnings of $1.77 per share against an expectation of 74 cents. Its backlog hit a record $4.5 billion running through 2040, up $600 million in the quarter alone.
And separately from that backlog, it was awarded a $900 million Department of Energy contract for high-assay low-enriched uranium in July, plus a supply agreement with X-Energy. We are keeping those separate deliberately. The $900 million is not inside the $4.5 billion.
Talen Energy reported adjusted EBITDA of $374 million. A year ago, that number was $90 million, so it is up $284 million year over year, and full-year guidance went up.
And its agreement with Amazon Web Services was restructured and expanded earlier this year to 1.92 gigawatts, running through 2042. Restructured and expanded is the accurate phrase there. It is not simply an extension of the old deal.
American Electric Power, we need to be careful with, because it is the one that was not clean. Operating earnings came in at $1.36 against $1.43 in the same quarter last year. That is a miss and a decline.
Revenue did beat. And the company still raised full-year operating earnings guidance to a range of $625 to $655 and laid out a $78 billion 5-year capital plan. But we are not going to describe that quarter as a beat because on earnings, it was not one.
The number from AEP that matters most is 69 gigawatts of contracted new load through 2030, up 6 gigawatts in a single quarter. And the context that makes that number legible is that AEP's existing system peaks at something like 30 to 37 gigawatts.
So that is not a forecast of total demand. That is incremental new demand, already under contract, roughly double the size of the system they operate today.
And Bloom Energy reported revenue of $1.07 billion against an expectation of $827 million. 166% increase year over year. Gross margin on a GAAP basis expanded 668 basis points to 33.4%.
So across 5 companies, 4 clean beats, 1 earnings miss with raised guidance, and every single one of them raised or extended its forward outlook. On the business side, we think the bottom is in.
Now the other half. And this is where we have less to show you than we would like, because we went looking for evidence and some of it did not hold up.
We wanted to tell you what institutions did with utilities last quarter and what fund flows did in July. We could not verify either to a standard we are willing to state on camera. Second quarter institutional filings are not complete yet, so we are leaving both out rather than asserting them.
What we can say is that short interest in the utilities ETF sits at roughly 5.5% of its float as of the most recent public reporting. For a sector that is traditionally where people hide, that is a meaningful amount of positioning against it.
And the stronger evidence is the thing we measured ourselves, which is the volume. In a genuine bottom, you usually get a flush, a session where everyone who is going to give up, gives up on enormous volume.
We have not seen that. Not today. Not in the 8 sessions before it. Nothing in this complex has traded on the kind of volume that marks capitulation. The selling has been steady and quiet rather than violent and finished.
And quiet selling is harder to call a bottom on because there's no moment where you can say the sellers ran out. They may simply still be there, working slowly.
So the businesses have re-rated and the shareholder base largely has not turned over. That is our read of the split.
Which gives us the sentence we would take away from today. The fundamentals bottomed before the shareholders did.
Contracts were signed, guidance went up, backlogs hit records, and the people who own these companies have not fully changed their minds about them yet.
That gap is not unusual. It is close to normal, actually. Businesses tend to turn before their shareholder registers do because it takes time for a new set of owners to replace the old one.
But we want to be clear that this is our interpretation, not a market consensus and not a fact. Somebody could look at exactly the same numbers and conclude that the market is correctly skeptical and that the contracts announced today will not convert into the earnings implied.
That is a legitimate reading. We do not hold it, but it is legitimate. What we would say is that if the fundamentals are right, the volume eventually has to show up. And if it never does, we were wrong about the direction.
The single strongest piece of evidence we found for the demand side is not from a company at all. It is from an auction.
PJM is the grid operator for 13 states and Washington, D.C., roughly 65 million people. Every year it runs an auction to buy the electricity capacity it will need a few years out.
In July, it ran the auction for the 2028-2029 delivery year. It cleared at $325 per megawatt day, which is the price cap approved by federal regulators, the maximum price it is legally allowed to pay.
For the third consecutive year.
And PJM's own analysis indicated that without the cap, it would have cleared at about $555 per megawatt day, roughly 70% above the ceiling.
Then the part that we think is the actual signal. Even paying the maximum legal price, PJM came up 6,831 megawatts short of its own reliability requirement. Second year running.
So a regulated market went out to buy electricity, offered the highest price the rules permit, and could not buy enough of it.
And it is doing something about it. On the 31st of July, PJM filed with federal regulators to create what it calls a reliability backstop procurement, a separate process to go find the capacity the auction failed to secure. Solicitation opens at the end of September, results in December.
That is a grid operator formally telling its regulator that the normal mechanism did not work.
And the demand side is not slowing. In January, the North American Electric Reliability Corporation projected summer peak demand growing 224 gigawatts over 10 years, a 24% increase and a 69% upward revision from what the same organization had projected just 1 year earlier.
So the forecast itself is moving quickly in one direction.
The companies say the same thing in plainer language. On Amazon's earnings call at the end of July, Andy Jassy said, and this is the full quote, "We will still not have enough capacity to meet all the demand we have in 2026. And I believe this dynamic will also be true in 2027 too. In fact, the demand we already have for 2028 is striking."
And Microsoft brought 88 data centers online across its 2026 fiscal year, including a full gigawatt of new capacity in the final quarter alone, the third consecutive quarter at roughly that pace.
So the auction says supply cannot keep up. The regulator's own forecast keeps getting revised upward, and the two largest buyers of this electricity say publicly that they are short. That is the demand case, and we think it is the most solid part of the whole story.
Separately, Alphabet fell about 3.6% today, and that is now a second leg down rather than a single bad session.
Since the 4th of August, the stock is down roughly 8.5%. There was a first leg on the 5th through the 7th, a small bounce on Monday, and then today.
The first leg had a clear cause. Google restructured the organization that builds Gemini. Its chief scientist of 27 years departed, and the DeepMind reporting lines changed. That broke on August the 5th.
Which is 6 days ago. It is not today's news, and we are not going to reuse it as today's explanation.
So what caused today? We looked, and we could not find a single confirmed catalyst dated the 11th of August. No ruling, no downgrade we could verify as the driver, no filing.
The honest answer is that we do not know. Our best guess is accumulated sentiment from the reorganization plus some risk reduction ahead of tomorrow morning's inflation print. And we want to label that clearly as a guess rather than a finding.
We would rather say we do not know than invent a headline that fits. If a catalyst turns up tomorrow, we will tell you what it was.
And it is worth noting the contrast within the same complex. Alphabet down 3.6, Amazon down 2.1, while Meta was up 0.7, and the semiconductor group was up 0.6. These megacaps are not trading as a block right now.
Let us be explicit about the limits of all this, because we have made a fairly firm argument today. We are not saying the power trade is confirmed. We spent 2 full segments on why we think it is not. Direction, plausible. Strength, unproven. We're not saying today's rotation continues tomorrow. Quiet moves reverse more easily than heavy ones.
And we are not making a recommendation about any of these securities. This is a description of what happened and how we read it. Nothing here is advice, and none of it accounts for your situation.
The thing that would change our mind is straightforward. If these companies start missing the guidance they just raised, or if the contracts announced do not convert into revenue, the fundamental case we made in segment 9 collapses, and the rest of it goes with it.
That is the test we are holding ourselves to. And the nearer-term test is tomorrow morning.
July consumer price data is released at 8:30 Eastern tomorrow morning. Consensus is for core prices up 0.2% month-on-month and 2.5% year-on-year.
The Cleveland Fed's nowcast, which is a model rather than a survey, is at 0.21%, so essentially the same place.
The detail that matters is the comparison. June core came in at 0.0% month-on-month, flat. So almost any normal reading tomorrow is an acceleration from June, simply because June was unusually soft.
Which means the risk is skewed toward a number that looks worse than it is, in a market that reacts to the headline before it reads the composition.
And the reason this matters more than a typical inflation print is where the Federal Reserve currently sits. At the July meeting, the committee voted 9-3 to hold rates steady. All 3 dissents were in favor of an immediate hike.
3 dissents in a hawkish direction is a lot. And going into tomorrow, Fed funds futures are not pricing cuts. A September hike is on the table as a live possibility, which is an unusual place for this market to be after several years of the opposite.
We are deliberately not putting a percentage on that because the number you get depends on which market you ask, and the different instruments disagree with each other right now. The durable point is the direction. The debate at the Fed is about whether to raise, not whether to cut.
Which is exactly why tomorrow matters to the trade we spent this episode on. Utilities and independent power producers carry a lot of debt and long project timelines. A hot inflation print pushes yields up, and that pressures the group we just spent 20 minutes making a case for.
So the rotation and the inflation number are connected. Tomorrow could confirm today or undo it.
So here is the day. 3 indexes down, small caps up, volatility low. Uranium, energy, nuclear, and utilities led the market. Software and 2 megacaps lagged.
The individual power names ran much harder than their sectors, and they did it on roughly ordinary volume. On a day, the market as a whole ran at about 70%. No surge, no capitulation, no confirmation either way.
Underneath that, 5 companies in the group reported quarters that were mostly strong and universally accompanied by raised guidance, while the ownership of those companies does not appear to have turned over.
That is what we mean when we say the fundamentals bottomed before the shareholders did. It is our reading, it is not the market's consensus, and it needs volume to confirm it.
The rotation showed up today. The volume did not. Tomorrow morning at 8:30, we find out whether it gets a reason to.
Thanks for spending the time with us. We will see you after the print. That's a wrap. If this was useful, follow or subscribe for the next one, and tell us where we're wrong. Thanks for listening.